Hi and welcome, and today we are talking again about the crypto tax. Critics have called the infrastructure bill's crypto provision a way too broad and for weeks tried to narrow it down but failed. Many in the industry claim that miners and developers who meet the bill's definition of a broker would be forced to provide reporting information they do not have the ability to collect. Many argued that the bill could possibly even move the whole industry overseas. However, the Senate rejected a proposed amendment to exclude miners, stakers, validators, etc. from a broker definition. Despite being rejected, though, the proposed amendment received a commendable pushback from businesses, lawmakers, and leaders who could help define policy on cryptocurrency. And now, according to a Bloomberg News report, the US Treasury Department is ready to offer an olive branch to crypto developers. Bloomberg said Friday, citing an unnamed department official, that Treasury won't go after crypto entities that don't meet the tax code's definition of a broker. Guidance on the matter could come next week, according to the report. The guidance would attempt to solve the issue with the Senate's effort to tax any service effectuating transfers of digital assets on behalf of other persons. The Treasury statement, which is not yet public, could provide a workaround by effectively limiting the bill's scope to those classified as brokers under the tax law. According to criminal law, the US tax code defines a broker as a dealer, a barter exchange, and any other person who, for consideration, regularly acts as a middleman with respect to property or services. Treasury is reportedly planning to exempt non-broker parties on a case-by-case basis. So, Treasury won't go after crypto firms that don't meet the tax code's definitions of a broker, and that is really good news. And meanwhile, Representative Don Bayer introduced the Digital Asset Market Structure and Investor Protection Act. The legislation seeks to protect consumers and promote innovation by sweeping all digital assets into existing financial regulatory structures. As Bayer put it, innovation in the digital asset sector is creating new goods and services every day, as well as many new high-quality jobs. The United States should provide a legal and regulatory environment which promotes this type of innovation and growth. It is clear that Bayers find this best method to promote technological innovation is through increased regulation and government oversight. The bill's introduction implies that he believes citizens are not capable of assessing and mitigating the inherent risk of being the custodians of their own wealth. And he went on to say that while digital assets and blockchain technology hold great promise, and while it's clear Bitcoin is here to stay, unfortunately, the current digital asset market structure and regulatory framework is ambiguous and dangerous for investors and consumers. Bayer's strongest belief is that digital asset holders have been subjected to fraud, theft, and market manipulations for years. And Congress, well, lawmakers have done nothing to prevent it. But now the Bayer's bill is going to change everything. Well, that's actually really, really sad, because no matter what Bayer thinks or any other lawmaker of the type, Bitcoin and other digital assets are still completely transparent and completely distributed. They have no centralized authority and they can't be hacked, and They can't be inflated. So that's a wonderful, wonderful thing, and just let it be. People, let it be. That's all for now. Bye.